let's just quickly have a look back at what happened in the past year. This is the returns till end of June 2025. And actually, it was quite a phenomenal year for any portfolio, multi-asset portfolio, even equity portfolios. There was some exceptional returns to be made. Over the past year, the South African JSE All Share Total Return Index delivered 25.18%. Followed by listed property at 24%, just shy of 24%, and even our all bond index returning 18.3%. Now remember, from a return risk versus reward point of view, your bond is actually your second lowest risky investment, just above cash. It depends obviously on what bonds and so forth. But from a normal risk return process, you returned 18.3% from a very low risk asset class. 7.8% in cash, and then the equity, the MSCI World Equity returned in Rand terms 13.15%. In the previous quarter, we showed you the statistics. It was actually quite subdued, only returning 4%, and you can see in the past 3 months, the Rand actually stabilized. We had a great Rand strengthening in the past year, but in the last 3 months it stabilized, and the developed world, there's definitely a risk on once again with developed market equities running again. If we just look at this from a USD perspective, as just said, these are developed market equity in USD. So we're putting our USD caps at this moment, returned 16.3%, but most of that returns actually was delivered in the past 3 months. 11.5 from the 16% was delivered in the past 3 months. There's a risk on after Liberation Day, after the whole tariff shock of Mr. Trump. Once again, I would recommend you go and read his book, The Art of the Deal. Shock and awe at first, know what you want, come back to the table with a deal and actually implement what you want to implement. And after that shock and awe, where the whole market just actually analyzing what's going to happen, we had some great returns. A slight outperformance in the past 3 months of emerging markets. So there's definitely a risk on perspective going on in the market. The question is, will that continue? And where do we allocate money if that should continue? And we'll touch on that just a bit later. But even developed market property returning 12% in USD, with treasuries and cash returning 4.7. So good returns was actually made in the past year until 30 June 2025, and most of your clients, most of your reviews, I believe, was a bit easier than in the previous few years. If we just quickly touch on the market outlook and what we see from a asset allocation perspective, and I'm going to run through just a few stats. Inflation is the first one. So there's definitely a tail risk of inflation. Although we do believe inflation is under control, you can see in the majority of the markets, United States, UK, China, and South Africa, there's a slight pickup, but nothing to be concerned of yet. I think the oil prices is stabilizing across the world, and that will keep inflation under control. The big question is just what will this impact of these taxes and import taxes and tariffs that Kevin spoke about? What will the actual impact be? The best guesstimates at the moment is not a great shock to the system. So we do believe inflation is under control, and we do believe that interest rates will drop slightly, not probably Thursday in the Fed meeting, but in due course, the second half of the year, we will be able to see some rate cuts. How do we see that? If you just look at the graphs and the fund expectations, the green is actually what the market expects, and it's a quick and a deep interest rate cut cycle. The Fed is still actually holding fast and is still a bit dovish, and you probably will see on Twitter the whole fight between Mr. Trump and Jeremy Powell, where he thinks Jeremy Powell is behind the curve and should decrease rates quicker. But there is that tail risk, inflation risk, and the actual impact of tariffs that Jeremy Powell would like to see in the data first before he will reduce interest rates. The interesting thing from an asset allocation perspective is the US bonds and US equity markets. This is a correlation graph between the US equity market and the US bond market. And as clearly can be seen, there's a very higher correlation between US bonds and US stocks at the moment. When there was a negative correlation, so anything below the black line is a negative correlation, it means these two asset classes move against each other. That was in a low interest rate, low inflation environment. As interest rates are a bit higher and inflation is a bit higher as well, so interest rates and inflation a bit higher, you definitely see a positive correlation between these two. And from the committee perspective, that's why we are still a bit underweight developed market bonds and global bonds as an asset class if you can't hedge any specific currency risk. From a global valuation perspective, the graph on the left-hand side is your major markets. Just to quickly touch on it, the light blue diamond was at January 1, 2025, and the purplish dark blue one is at the current diamond, is the current price of the markets. The graph at the back, the gray bar, is the 20-year range, and then your stripe or your is your 20-year average at that moment. And one thing that is clearly seen in this picture is that the US market is at the most expensive and at the top of the range it was in over the past 20 years. It's more expensive as it was at the starting of the year, but it is quite expensive, and there's definitely some risk with regards to valuation when allocating to the US market at the moment. Japan had a huge range, but it's sitting on its average basically at the moment. The Eurozone picking up in the past 6 months from basically average at 20.9 to 14.3. EM slightly more expensive, and China is back on par. The interesting thing is if you compare the US equity markets versus the developed market peers or the all country world index ex-US and you go per sector, it's quite interesting to see. So just to quickly explain this graph once again, that grayish bar at the bottom is the 20-year average discount of a US sector versus a non-US sector. So if we look at utilities as an example, there's a normal 15% discount of non-US utilities versus US utilities. The purplish diamond at the moment is the current discount to the non-US counterparts. Consumer discretionaries, there's a 50% discount from non-US consumer discretionary to US discretionary. And this is starting to get a very big, wide gap between normal valuations of US counterparties versus non-US counterparties. And there's a clear shift in allocation, investment allocation, away from the US for risk management into some great value or great companies, even quality companies in the US, China, India, and so forth. The only one that's actually trading on par is the healthcare sector, phenomenal healthcare systems, companies that's came out of the Euro at the moment, and they're actually trading on par versus the US counterparts. If we look at earnings growth, so what's going to happen if you look at the US at the moment, so the 2025 forecast with tariffs, with a realignment of companies, as Kevin alluded to actually mitigate the tariffs and what Trump is doing, we see a modest earnings growth of 9% in the US, but it will bounce back. We believe it's a short-term volatility, short-term inflation risk, but the companies are still doing great and they're still phenomenal companies, bouncing back to 14%. The biggest jump that we can see is in China. So China coming out of the property bubble at the moment, some subdued economic returns, GDP growth from China. We see a big earnings growth forecast in 2026, and that's most probably coming out of the technology companies in China. The reason being is they are catching up with the NVIDIAs and the like, and the whole AI infrastructures environment. And they are catching up with that, and the Tencents and Alibabas and so forth, building their own cloud system, building their own cloud warehouses. We believe that earnings will come through quite sharply. If we look at an earnings growth perspective, since 2020, the biggest growth came out of India, actually. Still an expensive market, but definitely worthwhile looking at to maybe allocate some money. Japan came out quite strong, and then only in third is the US. China lagging way behind, and is still at 100% of their earnings growth over the past 5 years. But we do believe in the 2026 financial year that earnings growth will jump quite dramatically. Just quickly to touch on and how we allocate the money and why we are still a bit underweight developed market or specifically US equities. If you look at the forward P and the subsequent 1 year returns, over a 1 year period, it's quite a difficult scatter plot. No real conclusion can be made from this, but we are sitting at the moment on average on about a 23 PE, and the next annualized return expected on average is very subdued at about 5%. A more realistic trend line can be seen if you annualize that for 5 years forward, and at a current PE of actually sitting at 23, there is a risk of subdued returns in the S&P 500 going forward. Something to touch on, and I'll touch on that from the active passive perspective as well. This is the dispersion between the 20 most expensive stocks and the 20 cheapest stocks on the market on the S&P 500. That's that gray bar at the bottom there, and the medium is sitting at the in the middle there. That's a huge dispersion. So there's definitely some argument to be had for active management in a market where we are today, as there is more opportunities with regards to valuations. South African equities on a tear. So with our infrastructure problems and so forth, I think it's just due to that subdued returns over the past 5 years and subdued business confidence that was really negative. Post GNU, we really had a good run in the South African equity markets, and we just carried on from there in the 2025 markets and surpassing the 100,000 points on the JSE at the moment. If we just compare that from a valuation perspective, once again, if you look at the forward PE of 22 of the US, we're sitting at about there. The premium relative to the 15-year medium is quite expensive. South Africa is still sitting below the mark, below the line there, with emerging markets also quite cheap. If you focus on South African equity as a focus point, we have jumped back from a very low 20% below average PE. We're basically on an average PE of where we should be over the past 20 years. But if you compare us relatively to emerging markets out there, we are still 20% cheaper than the normal emerging markets for there. If we just go back to normal, back to average, there's a 10% wealth to be made at least for South African investors in the South African market. The other one that we are favoring before I just go into fund solutions is South African bonds. We are still quite bullish on nominal bonds, not inflation linkers. So with the new target on inflation sitting at 3%, not formally implemented yet, inflation linkers, we believe is not the place to be. So we are still heavy weighted in the middle of South African bonds. But there's still a 11.5 to 12.2% return to be made from South African bonds, nominal bonds, without any expected interest rate cuts. Should there be interest rate cuts, we do believe some capital valuation on these bonds as well. So from this, you will see that we are underweight US equities and overweight SA equities and SA bonds, ever so slightly, mitigating risk. And if we can compare this to a recipe for sustainable returns, we are going on a quick culinary experience just to explain exactly what we do at I2 once again from a fund selection perspective. And as you would know, any good cook will work from a recipe, but from there it's mixing the right flavors, testing the food, adding some flavor, adding some salt to get to the perfect blend at the end. And we believe at I2, our secret sauce is in the screening of the funds. We use a methodical 3-phase model to know exactly what we're investing and understand the funds that we're investing, and then mixing different flavors together, diversifying across different asset classes. And then obviously when you have this recipe, when you've mixed all the ingredients together, you have to leave it and bake it until it's perfected. So the fund selection specialist, what did we do through diversification? If we just use an example as the global and SA equity once again, through our 3 phases, we believe that there's a place for passive and active in any strategy. So from a South African equity perspective, we use passive selection, and we do about 30% passive selection in the SA equity component and about 60% passive in the global equity component. Statistically wise, methodological wise, doing the research is actually shown that it's very difficult to outperform the active from a global perspective, but we do have more SA equity active fund managers that actually outperforming the passive, and that's why there's a difference between the passive allocations within each building block. But obviously, From an active perspective, there's some phenomenal active managers that can add some alpha. What did we do on our recipe? We showed this. We were increasingly scared or cautious on the US equity, developed market equity environment going into 2024, mid 2024. And we introduced a value fund manager. So we actually brought in the Ranmore Global Equity Fund. We tasted the recipe. We weren't happy with it. We wanted some more flavory, sweety ingredients in there to protect the hotness of our curry pot, if you can say it like that. And that's exactly what the Ranmore Global Equity Fund did. It protected on drawdowns, but it also participated in any specific upward trends. And this is just a statistic. So in any 3-year rolling period, Ranmore is not giving up on any returns. But as can be seen in the previous fund, the drawdown is well protected. And through that, we were able to, in our global equity fund selection, to actually reduce the risk of our entire portfolio. And that's what I want to get to. Just by being methodical, trusting your recipe, but adding some flavor when the time is right, we were able to protect downside protection, but still participate in the upside protection within the I-Squared Moderate Fund. On a 3-year basis, it's exactly where we want to be. We want to protect the downside, but we want to participate in the upside. And if you conclude that into a risk reward, we are able to outperform relative or peer group balance fund managers with the same amount of risk, but our return is still in there. And what do you get when you do that from an I-Squared Moderate solution? You get a rolling 3-year performing I-Squared Moderate fund versus the best of the best out there that's consistently first to second quartile over any 3-year period. So from a recipe perspective, if you add some flavor, if you can mitigate the risks in the market over a 5-year period, you can get a consistent first quartile performing fund in the I-Squared Moderate Fund. So I just quickly ran through that. Just from a perspective, I've touched on that, slightly overweight SA equity, slightly overweight SA bonds, slightly neutral to underweight DM equity, but definitely underweight US equity. And how's the performance? The taste test results, it's tasted and rated. Over a 5-year period, the I-Squared Moderate delivering 13.52% annualized return versus the category average of 11.93. That's basically a 160 basis point outperformance. Even in the past year, 18.5% versus 15.15%. That's a consistent feature on all the local solutions. If you want more detail of the global performance and the integrated solutions, please reach out to Elmarie for some comparisons. So good food will always be served here, or in our case, good funds. The biggest thing to know exactly is just to know your heat preference before you start cooking, know when to add some spices, and this is the range of available solutions from an I-Squared perspective on the risk return profile where we are. Thanks. That was a quick update just on the solution, where we are, where we sit. Great performance over the past year. We've added some tilts with value. We are increasing ever so slightly when the market dips into global equity markets. We still overweight SA equity, but slighter than we were a year ago. Took some profits from local bonds as well, and allocating that to different asset classes. If there's any questions, please feel free to ask. Thank you.
Fantastic. Thank you very much, Steve. This is the most amazing fund performance review that I've ever had the privilege of watching. And maybe it's just because I love food so much, but you know, it's brilliant. Like I don't think that there's anything I've seen before that makes so much sense. So yeah, I mean, brilliant. I've got 1 or 2 questions for you, Steve. So the one is just, you know, I mean, we sort of went through the asset classes and where you're a little bit overweight and neutral and so on. But which sectors or asset classes do you think are best positioned, specifically for you know, to help with resilience, you know, or to position us for growth in the current South African environment that we find ourselves? I mean, Kevin has shared a lot, but are there particular ones that sort of brings that so that we don't overheat the system, if you will.
Yes, exactly. So to add the exact amount of sweet in your portfolio, I strongly believe South African bonds is that place to be. If you just look at the returns at the moment, you're getting 10.9 to 11.5, 12.5%, depending on where on the maturity or the liquidity on the maturity chart you are. And if you think about inflation in South Africa, we're sitting at 3%, 3.2% inflation with a new target of 3%. Worst case scenario, there's a shock to the system, and those nominal bonds will probably, worst case scenario, can give you 6 to 7% over the year. You're still earning inflation plus 3%. If everything goes to plan, you're going to earn inflation plus 6%. So for any mild, moderate risk investor, I think nominal bonds, South African bonds, is the place to be. Is there risk in South African nominal bonds? Kevin will have more detail on that. But I strongly do not believe that. The South African government, I think it's borrowed about 90% of their debt in South African rands. The maturity table of that debt to be repaid is quite staggered along the next 10 years. There's no big payment in the next few years that needs to be repaid. So I do not think there's any big counterparty risk on your nominal bonds, South African nominal bonds. Our Reserve Bank is still quite independent, and I think they're doing a phenomenal job from my point of view. So that's the place where you can take risk off the table. If you want to add some flavor, if you want to add some chilies, I do believe there's some South African equities that can really just rebase. I think it's a valuation call more than a long-term infrastructure structural call in the South African equity markets. I do believe it's more of a spice to add in the next 12 to 18 months. If there's some good news coming out of South Africa that happened in the past year, you can easily once again see a 15 to 20% return in that market. But I won't spice my entire recipe with that specific asset class. It's a balancing act.
And then just a brief last question. Do you see that there's increased interest in alternative types of assets or investments? Are people sticking to the traditional stuff at the moment? They're not even talking about the crypto and all those, but I mean, let's throw that in there as well. Is there an increase where people are looking to hedge their bets elsewhere as well, and not just in the traditional asset classes?
Yes, definitely. I think there's more interest in the hedge space. I think there's a few great fund managers in South Africa that's introducing retail hedge funds. Cautionary, know exactly what you're investing in when you're investing in hedge funds. And then obviously there's a lot of private equity coming to market. I'm still a bit more cautious on the private equity. I believe if you want to go to private equity, do your due diligence properly. Go to one of the bigger investment houses that's got a track record of managing private equity. But we get a lot of clients actually asking us for due diligence on private equity type funds. Some of them can be invested in, some of them I will be a bit more cautionary about. But yeah, there's hedges definitely as a different asset class, hedge fund managers. So in a fund solution like I-Squared, we are actually reviewing a fund of funds, hedge fund of funds to include per risk profile. So we are seeing some alternative investment classes and alternative investment strategies coming to market, or getting queries on that.
Awesome.